After the whole world went through the pandemic together, you'd think the major economies would be, I don't know, rowing in the same direction. But instead, we're seeing something pretty wild. Two economic superpowers, China and Europe, are just drifting apart, and they're facing completely opposite problems. Okay, let's get into it and try to solve this economic puzzle. So here's the big question we're tackling today. How on earth did one single global shock lead to such a massive split? I mean, one economy is desperately trying to get prices to go up, while the other has been in a pitched battle to bring them back down. To figure this out, we've got to look at the clues, and it starts with the prices themselves. And this slide, well, it just lays it all out, doesn't it? On the left, you've got China, where prices are actually falling. That's deflation. But then on the right, you see the euro area, which is dealing with the exact opposite issue. Stubborn inflation that's going to stay above their target for years. It's like they're in two different economic universes. And to understand why, we have to start with the people who are actually doing the spending. Right, so it really all begins with the average person, the consumer. The way shoppers in China and Europe acted after the pandemic couldn't have been more different. And a huge piece of that story, maybe the biggest piece, starts with the housing market. Now check this out, because what's so interesting here is the relationship between these two lines. The red one, that's property price growth in China, and you can see it just takes a nosedive. The gray line is how willing people are to spend money. Look at that, they're practically moving in lockstep. As China's all-important property sector cooled off, so did the confidence of the average family. People got nervous, and when that happens, it changes everything. And this is the crucial part. This isn't just some abstract number on a chart. It has very real consequences. This chart breaks down retail sales growth. And just look at the bottom. Furniture, household appliances, construction stuff. These are the big ticket items people buy for their homes. And spending on them has been super weak. It makes sense, right? If you're worried about the value of your biggest asset, your home, you're probably not going to go out and buy a new sofa. But over in Europe, a totally different story was playing out. See, European consumers were cooped up for ages during lockdowns, and they were saving a ton of money. So the minute those restrictions were lifted, they were ready to spend. All that pent-up demand was just unleashed onto the economy, driving up demand for literally everything, from vacations to new cars. So you've got this stark contrast. Chinese consumers were holding on to their cash, while European consumers were spending it. That's one half of the puzzle. Now let's look at the other, the supply side. So, just like the shoppers went in different directions, so did the factories and the producers. One economy was dealing with way too many goods, and the other was getting hit with one painful shock after another. China's manufacturing engine just roared back to life after the pandemic. I mean, look at the production growth for things like solar panels and electric vehicles. It was absolutely explosive. But here's the problem. They started making things way faster than people were buying them, both at home and around the world. This created this huge surplus of goods. And basic economics, when you have way too much of something, prices can only go down. Meanwhile, Europe was getting hammered by wave after wave of supply issues. The war in Ukraine caused these massive energy price shocks. Food prices went through the roof, and the global supply chains, which were already a mess, just kept breaking down. Every single one of these things made it more expensive to make and ship goods, which, of course, pushed prices up for everybody. Okay, so whenever you talk about falling prices and a property slump in an Asian economy, one comparison always pops into people's minds: Japan's lost decade, right? And when we talk about inflation in the West, people immediately point to the US. But the thing is, these historical comparisons, they can be really misleading. And this slide just shows you why in a nutshell. Look at the difference in scale. The blue line is Japan's absolutely catastrophic property collapse in the 90s. Prices fell more than 76%. The red line is China's recent property dip. Yeah, it's significant, it's painful, but at around 13%, it's not even in the same ballpark. The situations are just fundamentally different. And here's another really key difference. In Japan, that property crash forced companies into this desperate spiral of paying down massive debts. It's called deleveraging, and it basically crippled investment for years. In China, while the real estate sector is definitely in trouble, we just haven't seen that same kind of panic across the entire corporate world. In fact, investment in other areas like manufacturing has stayed pretty strong. In the same way, it's a big mistake to just lump the euro area's inflation problem in with what happened in the United States. Research from the European Central Bank makes this crystal clear. Europe's inflation was mostly a story about outside supply shocks, energy and food. In the US, a red-hot job market and really strong consumer spending played a much bigger role. And the takeaway here is huge. Different problems need different solutions. So let's see what that means for the future. All right, so with totally opposite problems, it's no surprise that China and the euro area are now on totally opposite policy paths. And because we're talking about two of the world's biggest economic engines here, the choices they make are going to send ripples all across the globe. For China, the game plan is pretty straightforward. They've got to get their own domestic economy firing on all cylinders again. So their playbook is all about looking inward. Step 1, boost demand. Step 2, get people to spend more. And step 3, the big one, stabilize that shaky property market to bring back the consumer confidence we were talking about earlier.
Meanwhile, the euro area's mission is the complete opposite. They're trying to tame the flames of inflation. The European Central Bank's main weapon for that has been raising interest rates. This makes it more expensive to borrow money, which is designed to cool down spending and slow the economy, basically giving supply a chance to catch up so prices can finally level off.
So, why should you care about this big economic tug-of-war? Well, because its effects reach everywhere. China having way too many goods could mean cheaper TVs and solar panels for all of us. But it also means they're essentially exporting their deflation, putting huge pressure on businesses in Europe and America to slash their prices to compete. That's what fuels trade tensions. At the same time, Europe's higher interest rates pull investment money around the world. It's an incredibly delicate balance, and this divergence is really testing the stability of our whole interconnected world.
And that really leaves us with the big unanswered question for the next few years. In a global economy that's built on everyone basically moving together, what happens when two of its main engines start pulling in completely opposite directions? The economic stability that we've all kind of taken for granted, well, it might just depend on the answer.